There is a single fatal flaw that lies at the heart of nearly every speculator's ruin. It is a mistake so common, so seductive in its logic, that it has been responsible for the destruction of more Wall Street fortunes than any panic, crash, or bear market in history. It is the simple, catastrophic error of betting too big. The average man, his vision clouded by greed and his judgment inflamed by hope, stakes an amount on a single trade so disproportionate to his capital that he places his entire financial existence at the mercy of one roll of the dice. He believes that to make big money, he must take a big risk. Jesse Livermore knew this to be a lie. He learned through a lifetime of brutal lessons and spectacular triumphs that the greatest fortunes are built not upon reckless courage, but upon a foundation of profound, calculated caution. The objective of a professional speculator is not to get rich quick, but to get rich surely. This requires a mindset that is completely alien to the amateur. It is a mindset that prioritizes survival above all else. Before a speculator can even begin to think about profits, he must first ensure that he is protected from the one thing that can permanently remove him from the game: the catastrophic loss. The allure of the all-in bet is a powerful one. It speaks to the gambler that resides within every man, the desire to turn a small stake into a life-changing fortune with a single brilliant play. But Wall Street is not a casino. It is a relentless, impersonal arena where the laws of mathematics and human psychology prevail. Livermore understood that to risk one's entire capital on a single idea, no matter how sound it may seem, is to abandon the realm of speculation for the realm of pure, unadulterated gambling. And in that realm, the house always wins. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The core of Livermore's philosophy on risk can be distilled into a few powerful, non-negotiable commandments. The first and most critical was this: the speculator's capital is his business inventory, his ammunition, his very means of existence. To lose it is to be driven from the field of battle, rendered powerless to act when the great fortune-making opportunities finally appear. Therefore, the preservation of this capital was not just a prudent guideline, it was his highest and most sacred duty. It was the prime directive from which all other rules of engagement flowed. He learned early on that the market does not grant forgiveness. A single mistake, a single instance of recklessness, can be enough to erase the profits of months or even years of careful, intelligent work. The pain of such a loss is not merely financial, it is psychological. It shatters a man's confidence, clouds his judgment, and makes a rational, dispassionate approach to the market all but impossible. He knew this from his own experience, having been wiped out completely on more than one occasion. This led him to the adamant conclusion that a speculator must never risk a large portion of his capital on any single trade. It did not matter how certain the opportunity seemed, how infallible the tip, or how bullish his own analysis. The possibility of the unexpected, the unforeseen accident was always present. To ignore this possibility was to invite ruin. The professional, he believed, is not the man who is never wrong, but the man who can afford to be wrong because he never allows any single mistake to be fatal. He famously stated that it is absolutely wrong to gamble in stocks the way the average man does. The public, he observed, is more concerned with making money than with protecting what they already have. They will risk half their fortune with less reflection than they devote to the selection of a new automobile. This casual, almost flippant approach to risk is what ensures their eventual demise. They fail to treat speculation as a serious business, and as a consequence, they pay the ultimate business penalty: bankruptcy. The most insidious and destructive practice born of this flawed mindset is that of averaging down a losing position. When a trade goes against him, the amateur, unable to accept the small initial loss, buys more. He tells himself he is improving his average price, that he is buying the stock cheaper. In reality, he is compounding an error. He is throwing good money after bad, reinforcing a mistaken judgment, and transforming a manageable loss into a potentially catastrophic one. Livermore considered this the cardinal sin of speculation. To average a loss was to willfully defy the market's own clear verdict. The tape was telling him his initial judgment was wrong, yet he was choosing to argue, to insist that he knew better. This, Livermore knew, was a battle of ego against reality, and reality always wins. He was adamant: never average losses. It was a rule from which there could be no deviation. His approach was the polar opposite. He did not add to a losing position, he cut it without a second thought. But he would, with great confidence, add to a winning position. This practice of pyramiding was central to his strategy. If he bought a stock and it immediately showed him a profit, it was the market's confirmation that his judgment was correct. He was on the right side of the move. It was then, and only then, that he would consider increasing his line. His biggest bets were always placed on trades that were already successful. This method ensures that the speculator's largest positions are aligned with the market's primary force, while his inevitable mistakes result only in small, controlled losses. It is a strategy of offense built upon a foundation of impenetrable defense. It requires the discipline to cut trades that do not act right from the very start, and the courage to add to the ones that do. It is, in essence, a way of letting the market itself guide your capital allocation. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. The practical application of Livermore's risk management was not a matter of vague feeling, but of cold, hard mathematics. While he did not speak in terms of modern portfolio theory, his methods were a practical embodiment of fixed, fractional risk management. He understood that to survive, he could only ever risk a small, manageable portion of his total capital on a single idea. He needed to be able to withstand a series of consecutive losses without having his trading ability significantly impaired. Consider the speculator who risks 10% of his capital on each trade. A string of just 5 losses, a common occurrence, will reduce his capital by nearly 41%. His ability to recover is now severely diminished. The speculator who risks only 2%, however, would have lost less than 10% of his capital under the same circumstances. He remains strong, his capital largely intact, ready to capitalize on the next opportunity. This mathematical reality is the unshakable logic behind conservative position sizing. Livermore never entered a trade with his full intended line at once. This was another critical tool for risk mitigation. His method was to probe the market, to send out a scout. He would begin by taking a small initial position. This was his test. If the stock moved in his favor and showed him a profit, it was a signal that his judgment was correct and that the line of least resistance was aligned with his trade. Only then would he add to his position, and he would do so on a scale up, always buying at a higher price. If, however, that initial probe resulted in a loss, it was a clear sign that his timing was wrong. The market was not ready for the move he anticipated. He would not wait or hope. He would immediately close the trade, accepting a small, insignificant loss. This method of testing the market before committing his full force ensured that he never found himself heavily invested in a position that was not already working in his favor. It was a way of demanding that the market prove him right before he placed his big bet. The final and most crucial component of his risk management was the disciplined use of stop losses. A stop loss, in his view, was not an admission of potential failure. It was a non-negotiable insurance policy against catastrophe. It was the predetermined point at which a trade was proven to be wrong, and it had to be honored without question or hesitation. To fail to place a stop, or to move it further away in the hope that a stock would come back, was to abandon all discipline and surrender to the whims of fate. He had learned this lesson in the most brutal way possible. He had seen his own fortunes evaporate because he had held on to a losing position, his judgment clouded by emotion or the persuasive personality of another. He knew that the human tendency is to hold on to losers and sell winners too early. A mechanical stop-loss is the antidote to this self-destructive impulse. It takes the decision out of the hands of a fallible, emotional human and places it in the realm of cold, unemotional mathematics. The core principle that ties all these tools together is this: the speculator must always be in a position to act on the next great opportunity. The only way to guarantee this is to ensure that no single trade or series of trades can ever inflict a fatal blow to his capital. By risking only a small percentage of his account, by scaling into positions on strength, and by adhering to a rigid stop-loss discipline, he builds a fortress around his capital. He creates a business that is resilient, that can withstand the inevitable downturns and periods of uncertainty. This, then, is the rule that 90% of traders miss. They are so focused on the potential for profit that they neglect the certainty of risk. They chase after the big score, the one trade that will make them rich, and in doing so, they expose themselves to the one loss that will make them poor. Livermore's genius was in his recognition that this approach was a fool's game. He chose instead the path of the professional, the path of the survivor. His ultimate rule was simple: you must manage your risk, or the market will manage it for you, and its management style is always ruthless and final. By making the protection of your capital your highest priority, you are not limiting your potential for profit. You are guaranteeing it. You are ensuring that you will be present, solvent, and psychologically sound when the next great trend appears. For it is in riding these great sweeping movements with a position built carefully upon a foundation of preserved capital that true fortunes are made.